So we have another major problem, and this problem has to do with our banking industry. We know that the Federal Reserve is contemplating whether or not to lower interest rates here in the next month. But what you may not know is how they understand what is going on in the economy, what is going on with our banking industry. Well, that is a survey that the Federal Reserve sends out. It's every quarter. They send it out to the banks. The banks fill it out and let them know what's going on. Are people coming in to get loans? How tight is lending? Are certain banks giving loans to just anybody? Maybe they're micro loans. This is something that the Federal Reserve looks at this survey. They look at the data that's coming in and they evaluate it. Well, what was said just this past week for this past quarter was very interesting, because banks came out and said, well, in just simple terms, that they are screwed. That the Federal Reserve raised rates and they kept rates too high for too long. And now banks are struggling. This isn't something that we think is new information. We've known this for some time. But what is new information is how much these banks are struggling. We learned from JP Morgan Chase just recently that almost 80 million people are going to have to pay for a checking account because JP Morgan is struggling as well. JP Morgan's our biggest bank in the United States, and they're struggling. It's not a good look. Now, some people are thinking, well, once the Fed cuts rates, which they're anticipated to do the middle of September, they think, okay, we're good, we're golden, because once rates start coming down, businesses are going to start to go and get loans. Individuals will go and get loans, mortgages, auto loans, credit cards. Banks are going to be making a boatload of money. But historically, that's not the case. This is why multiple analysts are now saying that as soon as the Fed cuts rates, you should sell your stocks. Sell them. Because historically, we've seen drops over a quarter. We've seen drops of 12%, 15%, 22%, okay, over the first quarter once the Fed decides to cut rates. But why? Well, this is the reason. And I told you guys this last week, and I said, just be aware that when the Fed decides to cut rates, this isn't a time to celebrate. No, this is a time to be prepared for what is coming, and that's when you celebrate. Here's what I meant. When the Fed starts to cut rates, what happens is, again, it's the beginning of a easing cycle. So when we have rates at 5.25 to 5.5%, what they are right now, the problem is when the Fed cuts it to 5 to 5.25%, many people are going to be looking at that like, okay, they cut it by 25 basis points. That's great. But that doesn't save me much money. A 1/4%. That doesn't save me a lot of money. Maybe I'm just going to wait and I'll buy a house when it gets down like 1 to 1.5%, right? 100 to 150 basis points. That's the way the American people look at it. That's the way businesses look at it. That's the way banks are looking at it as well. I was talking to a friend of mine just recently. He manages a regional bank over here on the West Coast. And he was saying that his bank, over the past month, they've actually started reducing the amount of staff that they have. They don't have as many lenders, and they haven't had many lenders for a year and a half, something like that. And the reason for this is simple. He knows what's coming. It's his job to determine whether or not these employees are needed. And what he told me the other day was somewhat frightening. He said that major banks across the United States are going to realize that they are overemployed. They have too many people for the amount of customers that they currently have. Yeah, that's a problem, because now banks are going to start to let go of their employees. When banks start letting go of their employees, which we have seen before, it becomes very, very restrictive. Because now, when you go into the bank and you need a loan, you have to set an appointment. I remember back on my very first loan, I walked into the bank, told them, this is what I'm thinking about doing. I just don't know the process. I walked out of the bank with a loan that day. That's how easy it was. Today, if I walked into a bank and said, this is what I'm thinking, this is what I'd like to do, I want to get a loan for my business, whatever, they would most likely tell me, okay, well, go talk to this person. This person will then set an appointment so you can go talk to the actual person that can fill out the paperwork. Then we'll send that paperwork to the person that is going to whether maybe approve it or deny it or make some changes. Okay, so I have to go to 3 different people just to get an answer? Yeah, that's where things are at now. Now, here's where it is going to go from bad to worse. Remember what I just said? I just said banks are struggling, and we know that. Also said that what we are about to face when we see the first interest rate cut, people are going to wait. They're not going to go in and get a loan just because the Federal Reserve decided to cut rates by 25 basis points. They're going to wait. But how long are they going to wait? This is the concern. The concern right now is we have a commercial real estate crisis, mortgage crisis, that is going to hit the United States in the first quarter of 2025. The Federal Reserve would need to cut interest rates enough to see a substantial change. According to experts, they say the Federal Reserve must reduce interest rates by about 1.75%. It's 175 basis points. I don't know if the Federal Reserve gets there before the end of 2024. They could. They easily could. I just don't know if they do. This is also why many banks are now warning their customers to be prepared for some big changes. You may see your credit cards get hit. You may not have a $50,000 credit limit on your credit card. They may reduce it to minimize their risk. You may see that a personal loan that they have for you, that maybe they've been very lenient on collecting payments. Maybe an auto loan that you missed multiple payments on. Banks are going to come after you. Banks can't sit around and wait 6 months for you to make one payment. As far as a mortgage, this is the big one. Before, and I think still on average, takes about 16 to 18 months from you to start missing payments before a bank actually forecloses. The expectation is that this is going to be closer to 6 months to a year, probably 9 months to a year. And the reason for that, again, there's a lot of paperwork, but the biggest thing, banks can't wait any longer. So we're going to see what happens moving forward. The one thing I can tell you is just be prepared, because I don't know if the Federal Reserve cuts rates quick enough. I think we're going to have more problems. And as we get those problems, I think those problems begin to compound. So just understand these little issues that we're having could turn into a massive problem here in the near future. So we'll see what happens moving forward. All I can tell you is I'll be here every step of the way, and I'll fill you in on all the latest news and updates. That is what we know as of today. So again, thank you guys for watching. Consider subscribing, and I'll see you guys on the next one.